and welcome to Swissquote's Daily Market Talk. It's Wednesday, January 14th, and politics and geopolitics remain at the heart of the price action across the global financial markets. Concerns around the Federal Reserve's independence weigh heavier than soothing inflation numbers from the US, while the earnings season adds another layer to complex investor sentiment. Here, the S&P 500 profits are expected to grow by more than 8%, which is a strong number, once again carried by big technology, but with valuation stretched, strong numbers alone may not be enough to revive appetite. Investors want discipline, not just growth, and that's becoming the real test for the AI trade. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So US stock indices consolidated gains near record high levels as the soothing inflation data yesterday was blurred by Fed independence worries and other political matters and failed to send these indices to fresh all-time highs. Now, looking at the economic data, the CPI update from the US came in line with expectations yesterday. The headline inflation printed a steady 2.7% year-over-year growth, while core inflation also came in at a steady 2.6%. That was lower than a consensus of analyst expectations on a Bloomberg survey. Cherry on top, for the Fed does, real earnings fell in December, a thing that should also tame demand and keep inflation in check. But the US 2-year yield fluctuated yesterday above the 3.5% mark, and the probability of a March rate cut from the Fed was pulled further down to below 30% from around 50% last week. The US PPI data is due today, and soft figures may not revive the dovish Fed spirit. Why? Because today, the market pricing is not only influenced by economic data, it's also influenced by politics, And I believe that a widespread support to the Fed President Jerome Powell in this DOJ issue is to blame. JPM CEO Jamie Dimon, for example, said yesterday that Mr. T's administration's attacks on the Fed could backfire and push borrowing costs and inflation higher. And he's right. Cutting the rates more than necessary today would increase inflation expectations and inflation tomorrow, and that would mean higher borrowing costs for longer for the US economy. Duh, that's economics 101. And that's pushing the longer term yields higher these days and leads to the steepening of the US yield curve, which is not exactly the outcome that the White House wants. But Mr. T doesn't want to hear a word of it. Either way, the next Fed chair is about to be announced in the next few days and weeks, and that should keep the Fed independence worries well in the headlines. And these worries will obviously continue to undermine the appetite for the US dollar and US treasuries and support gold and silver that continue to rally toward fresh record highs. Silver traded past the $91 per ounce level this morning in Asia. As per the US economy, Jamie Dimon reiterated yesterday that the US economy has been resilient and that consumers in the US continue to spend and businesses generally remain healthy. And as per its own results, the fourth quarter earnings at the JP Morgan were solid overall, with stronger than expected profits helped by trading and interest income, but earnings were actually held back by a large one-off cost tied to the Apple Card business, and deal-making revenue missed estimates due to delays to this quarter. So the stock did more than 4% post-earnings yesterday, and the S&P 500 also fell along with the technology stocks as well. But overall, JP Morgan's verdict was rather positive for the US economy, and that's good news for the broader equity complex. Today, the Bank of America, Wells Fargo, and Citigroup will go to the earnings confessional and announce their fourth quarter earnings and their forecast for the future. Let's see what they have to say. Now, zooming out, and despite all, the S&P 500 companies are expected to print a more than 8% earnings growth for the fourth quarter. Technology is obviously expected to do the heavy lifting, again with fourth quarter revenues seen growing about 18 to 20%. That's strong but moderating momentum compared with prior quarters. And because the US technology is valued to perfection today, impressive headline figures will not automatically trigger market rallies. Investors will rather want to dive also into how the revenues and loans are being backed to make sure that the numbers tell the story and not hide the risks. Speaking of risks, well, technology investors see two main risks to the AI rally today: overspending and over-leveraging. So the companies that address these two issues, these two risks, are in a better position to extend their gains. Those are companies with low debt levels, ample cash, and that offer the broad entire supply chain from chips to AI models and applications. And there is no secret, these companies are Google, Microsoft, and Amazon. And for those who are actually looking for cheaper AI deals, the Asian technology remains the place to go. The Korean Kospi Index is up to a fresh record high again this morning. The Chinese Hang Seng Index consolidates near last October's peak levels, and the Japanese Topix Index, which is also heavy in technology stocks, is up to a fresh record as well, bolstered by the expectations of stronger fiscal support from the Japanese government in case Madame Takaichi consolidates her power at a snap election. Zooming out of the technology, the cheaper US dollar and cheap energy prices so far have also been supporting the EM stocks, and the World Bank also raised its growth forecast for this year, surprisingly saying that the global economy has proved to be surprisingly shockproof in the face of historic escalation in the trade tensions. The US economy could see a sizable growth boost, they said, while China and India are expected to print strong growth numbers, near 5% for China and up to 6.5% for India. That's obviously supportive for further gains in EM stock markets. And speaking of these trade tensions, last Friday, the US Supreme Court didn't say much about the tariffs imposed by the administration on questionable and unjustified reasons, if any reason at all. So it's expected to do so today. If judged unlawful, the US government must give back the tax collection money to many companies that filed complaints about these tariffs last year. And if that's the case, the US budget could see its deficit hole get bigger. The latter would be not so great news for the US bonds, obviously they're already under decent pressure, but it would give a much needed relief to those who export to the US and those who import from the US, like the car companies, consumer staples, and even technology, which cheer the news. But don't get too excited because tensions are never far away. Mr. T said yesterday that he's imposing 25% tariffs on goods from countries doing business with Iran amid countrywide protests there against the regime and violent backlash. And you know who is very much concerned? China. China is one of the biggest buyers of the Iranian oil, and an additional 25% tariff on its US exports could obviously revive the trade tensions between the two countries. Soybean futures are seen as a barometer for the health of the US-China trade relationship fell on latest developments yesterday, and they have been under pressure, as you guessed, since a while now. As per crude oil, the Iranian unrest is pressuring oil prices higher, along with attacks near the Caspian pipeline disrupting Kazakhstan's exports and compounding delays from harsh winter weather and also mooring damage. As a result, the US crude spiked below its 100-day moving average at the start of this week and to $60 per barrel level, but the US crude inventories rose by about 5.3 million barrels last week. That is a big number, much larger than actually expectations for a build of about 2 million barrels, and also the highest in 2 months. Telling that once the temporary supply worries in crude markets are cleared, well, the prices will likely return to the bearish trend. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.